there should be people in your life when you make decisions, in all kinds of decisions, that are in a position to tell you no, like that are okay to tell you no or okay to push back a little bit.
Sure.
And a good fee only independent financial planner can be that person for you.
Hey, ambitious dentist, welcome to Start Your Dental Practice, the show for existing and aspiring dentists to take your dental practice to the highest possible level. I'm your host, Jonathan Van Horn, CPA and ABV, founder of dentistmetrics.com. Every episode, we aim to demystify the how to start a dental practice problem by bringing on world-class dentists, influencers, and consultants in the dental industry to pick their brain about how to get past the barriers involved from going from no practice to being a practice owner to owning your own successful dental practice.
Hello, ambitious dentist. Today, I have a real treat for all of us. As you know, I am a CPA, but I don't have anything to do with our company with investments. There's a lot of people out there right now that are curious about your retirement. I know it's not on the top of mind of everyone that's out there every day, especially in the people that are listening to this podcast, because we do trend to be a little bit younger on this podcast, but I'm sure our guest today would say that would be a fantastic time to start thinking about and planning for your retirement. So today, I have with us Mr. Ryan Isaac, the co-founder of The Dentist Advisors, as well as a co-host of the fantastic podcast that you should go and check out, the Dentist Money Podcast. So, Ryan, thank you so much for coming on the podcast today.
Yeah, John, thanks for having me, man. It's great to be here virtually.
Yeah. So, tell us about Dentist Advisors, the Dentist Money Podcast. Tell us about what it is that you set out to do every day whenever you come in to spread the good news.
Yeah. Spread the word of financial planning. So our tagline on the podcast is it's the Dentist Money Show, where we help dentists make smart financial decisions. So I would say first and foremost, that's what our goal and our mission is, just help dentists make, more smart financial decisions and less bad ones over the course of their career through good, real financial planning and good investment philosophy and implementation.
Very nice. So, as I mentioned in the intro, a lot of our listeners are young, either soon to be or just became practice owners. And everybody that is listening is going to have that day where they say, I'm done with dentistry. I am no longer going to have an income from this trade that I set out in life to do. And the concept of retirement is probably foreign to a lot of people, if not at the very least misunderstood. So what do you feel like the most common misconceptions about retirement are?
It's kind of like this thing where it's always in the back of our minds. Like, we all know we're supposed to make better financial decisions and save money for the future. We all know. It's kind of like how we all know we should do healthy things, with our like food and exercise,
Oh, that's true. Yeah.
Yeah. We all know it. And some people do it. And then a lot of people, though, it's like it just feels like a really vague, like retirement feels like such a vague thing. And as the generations change, the definitions of what that even means, like if you asked my dad what retirement means, he's going to have a different definition that I'm going to have. And if you ask a 22-year-old new grad or student what retirement means, they'll probably have a different definition than I will. So I think for one, it just feels vague. It feels really far away. It doesn't feel like a high priority because it's like hard to define, and it's just 30 years from now. So I think when people think about it, it's just this thing out there. It's like it kind of weighs on you a little bit. You should do something about it. You don't really know what you should do about it. And it's definitely not the highest priority in a lot of people's lives, especially a young dentist like your audience. I mean, there's just so many other things going on to have to worry about what that 30-year future is supposed to be. So I don't know. I think it's just it's a hard thing for people to conceptualize and figure out what that's even supposed to mean.
It really is. So do you feel like a lot of people should have their own individual definition of it, or do you feel like that it's comes down to what? Because I mean, I'm in Little Rock, Arkansas, which is a pretty low cost of living area where,
Yeah.
you could, if you have a $200,000-$300,000 house, you've got, probably 4,000 square feet to work with.
Everyone in like Seattle and SoCal and New York are like, what?
Ooh, yeah, they just cringe, right? They're like, wow,
Yeah.
these guys in Arkansas have mansions.
Arkansas.
Yeah.
You got land and stuff with that too, I'm sure. You got like a good yard.
Yeah, exactly. So, whereas, counter to that, if you're in New York City, those numbers are just very, very different. So
Completely.
would you say that a lot of that has to do with, would you say that somebody that is fresh out of dental school that's in New York should have a different definition than a person that's in, Little Rock?
Well, yeah, and that's the issue, is that because it's this kind of undefined, vague thing that's so far in the future, no one's forcing us to do anything about it. Like your student loans or your mortgage, you're forced to do something about that. That's why that's one of the reasons why debt feels so compelling to try to pay down really fast, is because someone's forcing us to do something about it. In retirement, no one's forcing us to save any money. I mean, we can spend every penny we have for the next 30 years and no one's going to do anything about it.
Mm-hmm.
So I think to your question, how should someone define it? First, I would say that's going to be an evolving target. There's a lot of people are going to be starting out their careers in their, early 30s, feeling like they know where they're headed. And you're going to hit 40. You're going to be like, wow, I have a very different definition of what career means to me and what's important to me and where I'm headed and what I want out of all this. So I would say, be flexible, be fluid, but realize that nobody's forcing you to save money for the future. You have to start somewhere, and it's going to cost you money. Like you're going to lose your income at some point. And the generation we're talking to, I don't know what to say about Social Security. Is it going to be there?
Yeah.
The fix to make it last isn't that hard of a fix, but what will happen, in 40 years? Will there be any kind of government Social Security, or is it going to be all on their shoulders? I don't know. And so I think, you kind of just you always want to keep in mind what your definition of that means. Here's what I think is cool about dentistry, though, that is such a great profession. And a lot of people ask, is it worth the student loans? A lot, the new classes coming out now, it's like $500,000 to become a dentist. And while that's really expensive, and that, historically it seems crazy compared to even 10 years ago, dentistry is such a cool profession because it has so much longevity. Yep. And it has so much earning potential, and it has so much flexibility. So really, like, you could just hit it hard through your 40s and your 50s, and you could be done owning a practice and the headache of owning a practice in your early 50s, but not even be close to be done working. And it's hard to think of a profession where you can work 2 days a week and make a 6-figure income, but that's easy for a dentist. You can make $100,000 a year and work a day and a half a week, until you're like 75 years old. And if you love it and you keep up in your skills and your body's healthy and your mind's healthy, then it's just a cool career with a ton of longevity. And the longer you can work, the more money you can earn, and, the better your chances for actually having a future and having wealth and having a net worth to sustain your spending later on becomes.
Yeah, absolutely. And, I one of the questions I always ask our clients is, what is your goal with your business? Like, are you trying to buy a practice because you want to have one practice, or you want to just own a business, or is it that you want to have a mega office with 15 operatories and you have specialists come in all the time and there's 2 associates, and or do you want to have one really good practice that does $1.5 to $2 million a year and it's just you doing really big cases? Or do you want to have 30 offices and a ton of associates and have do the equity model? And what is it that you actually want out of this thing called business? And sometimes I get really good answers to that and sometimes I get I'm not really sure what it is I want yet.
Yeah, totally.
I'm gonna let this practice go and we're gonna see where it goes. And I feel like with retirement, that mentality can sometimes it can allow you to put it off for too long.
Mm-hmm.
Because you talk about all these things, all these loans, you get student loans, maybe you have a home, maybe you have a practice loan, you have all these things that, that debt is just so, conceptually, it's conceptually insurmountable.
Yep.
But you also have to start thinking about the opposite end of that spectrum of saving while you have tons of debt.
Mm-hmm.
And that's a super hard mental, bridge to gap on
Yep.
occasion. So how do you guys reconcile the two?
Yeah. So awesome question, man. I think there's probably a couple parts to it and we'll give some numbers here. Let's make this concrete for your listeners. At a really high level, in order to sustain your spending on your net worth, basically have enough net worth to just keep spending without needing a job anymore, your net worth is going to have to be like 25 to 30 times what you spend in a year. Mm-hmm. So for example, if you spend $100,000 in a year to live, that's your living expenses in a whole year for your family personally, like not business, then your net worth, if you have a net worth of $3 million that you can spend into, like real estate you can sell or rent, or businesses you can sell or take net income from, and retirement accounts you can get money out of. If it's $3 million, that's a 30 multiple of your annual spending. And at that level, your withdrawal rate from your net worth is low enough to sustain indefinitely. So just conceptually, in our business, that's something we measure for our clients in our financial planning process. We call it a total term. Mm-hmm. And it's just net worth divided by annual spending. And if that number's above a 25, you're pretty darn healthy. If it's above a 30, it's kind of like you have indefinite spending at that current spending level. So mm-hmm. right out of the gate, that's kind of like a metric that someone can keep in the back of their minds. Now, to get there, a dentist is going to need to sustain, and it's definitely not going to be like this in the beginning of career, and it's going to be more than this towards the end of career. But a dentist is going to need to sustain about a 20% savings rate over the course of his or her career to hit that kind of a point at a normal age, at a normal like early 60s, kind of mid 60 age, to hit a net worth that big. And that's income dependent. Some people are going to be like closer to a 15% savings rate. Some people have businesses that are larger where it'd be more appropriate to be saving 25 to 30% of their income. But dentists have more debt, they have higher taxes, and they spend more money than the average person. So where maybe, the average American could build a great retirement on a 15% savings rate their whole life, a dentist is going to need to sustain close to a 20. So right out of the gate, we have this metric of I need my net worth to be 25 to 30 times my annual spending before I'm realistically able to stop taking an income from a job. Number two would be, in order to hit that, I got to sustain a savings rate over my career of, at least 15%, but hopefully 20% or above. And again, that's hard to do in the beginning, so don't stress if you're not there in the first 5 years of your career. And then number three, with the debt, debt's hard, man, because it carries like a very emotional baggage to it. It feels so good to get rid of it. It feels more tangible than putting money into like a 401k. A lot of people feel like a 401k is like, it might as well be a casino. It's just this pile of money that just floats around. I don't know what it does. It's not tangible, but it is. And debt feels like this really like tangible thing. So we encourage our clients and our listeners to think about debt as a tool that led you to get where you're at and have this amazing career. And we love people to get rid of debt. We like people who get out of debt sooner than later. That's a really healthy thing to do, but we won't encourage it at the expense of a healthy savings rate. So we'll just say, hey, look, let's try to maintain a healthy savings rate, and anything above that amount that you want to put towards your debt or put towards your lifestyle, go ahead and do that. But let's hit a minimum savings rate before we start attacking debt too aggressively. Let's hit that 15% or let's hit that 20% before we take any extra money to pay down our debts faster or to increase our lifestyle. But, if you can maintain that savings rate and then you keep growing your business and your income and you have more money on top of that, then you can pay down your debts and save at the same time and have a really healthy balance. The truth is, the bank's going to make you pay down your loans. And even if we pay minimum payments and we all hate it and we hate the interest we pay, and some people hate banks, even though like I don't get that because that supplied their whole opportunity,
Sure.
It's going to go away, and like in our company, we measure every quarter someone's net worth and how it changes. And one of the things that surprises me every time is how much net worth increases people get out of making minimum payments on their debts. The average dentist is going to have a few student loans, a mortgage, some practice loans, maybe some other real estate loans. And just making minimum payments on those debts over the course of a year is increasing people's net worth by tens of thousands of dollars, So it doesn't feel like it, but when you measure it and you can compare it to the past, you'll see that you're still making progress by making minimum payments. Those debts will be gone, even if you only make minimum payments forever. Your retirement is not on a schedule. No one's forcing you. So, just know what your targets are, know what your ideal savings rate would be, and try to achieve that before going too aggressive on debts. That would be my strike a balance kind of advice for somebody.
So as far as the numbers you've talked about so far, just to recap, you talked about having 30 years, kind of having a 30-year X goal, 30X goal for whatever you spend in a year. So the first thing the dentist would need to do is look at about what they would anticipate needing to spend in a year, and timing that by 30 in a simple method.
Yep.
What do you say to the people out there that are thinking, man, 30 times what I spend in a year, I spend what I make in a year.
Yeah.
How I get started now, and I'm gonna go with this 20% savings rate. I'm gonna make sure that I do that. And, let's say that let's say they're 35 and their goal is 65, for whatever reason. And so they basically say, okay, I've got 30 years to do it. I got to save, 1 year's worth of income every year for 30 years to be able to get to that level.
Yeah, it seems crazy.
Right. It seems scary in a way. And I know there's math behind this to get us out of that.
Yeah.
But I'm just giving you that question to be able to, because I know that there's people out there that are thinking
for
that
sure.
right now.
Well, and that's with good reason. And the reason is because you can't do that. Mm-hmm. That's the reason. Mm-hmm. The truth is that's just an average. Now, we've been measuring hundreds of dentists over the last decade, and I can tell you that the average dentist over a career can absolutely achieve that if they start early enough. Now, what the average does not tell you is that for the first 10 years of your career, you're not hitting average numbers. Mm-hmm. You might be able to save, if the goal every year is to save, basically your net worth has to grow by what you spend in order to hit that metric, but you might go the first 10 years of your career and be like half of that. The reality, though, is that if you continue to save money and build up retirement accounts and invest in your practice and build a good business and pay down your debts, that last half of your career is where you get the real, you might be going 2-to-1 and 3-to-1 in the last decade of your career, And if you think about the way investment accounts work in public markets and people with 401ks and brokerage accounts and mutual funds and all that stuff, it doesn't really matter if your return is killer if the balance is 50 grand,
Sure.
But you can get an average return, even a mediocre return on a conservative portfolio if you got $2 million in there, and that makes a big difference to your bottom line, in actual dollars. So what people have to keep in mind, it's just a really long-term game. Like anything worthwhile in life, it just takes a long time and it's a grind and you don't see quick progress. But eventually that practice is going to be paid off and worth 7 figures one day. And so will the real estate. And your investment account that was once 20 grand is now 7 figures too, and in an average year of growth in markets, it's a lot of money hits your bottom line. And now there's more money being kicked off from your investments than you're even saving in a year. So that last 10 years can make up quite a bit if you laid the groundwork before. And the groundwork is just good habits, good decision making. And even if, it's good savings rate. And even if you can't hit the savings rate early on, save $250, save $500, save $1,000, even if it represents 5% of your income when you're first starting. The things that'll do for you, emotionally and psychologically, to get those habits early will just carry benefits really far throughout your career. So, it's true that you can't achieve that right out of the gate, but the average dentist can absolutely achieve it. And the other cool thing too that you probably see a lot is in the last 10 years of a dentist's career, they have a lot better opportunities for large retirement plans like pensions and cash balance plans because the age requirements and the testing works out so well. So if you think about it, you also have this opportunity in the last part of your career to save quite a bit of money in taxes through large contributions that you couldn't do in the beginning, that just further compounds that momentum at the end of the career. So it's all about the grind and the work today, just like the business is. All the stuff that goes into building a practice or buying a practice and getting it just going for the first 10 years it's so much work. It's such a grind, but it pays off in the end if you do the work in the beginning. And planning for retirement and building a net worth is the exact same process.
So start small, start somewhere, but
do something.
Just start.
Yeah.
Yeah.
Well, yeah. And I'm kind of exercise is my daily therapy. It's my mental stability, so I like to liken things to or compare things to diet and food and exercise and keeping our bodies healthy. And it's if someone has a very large goal, maybe it's they've never ran before and they want to hit a marathon, or they want to lose a lot of weight, like none of that progress is going to happen quickly, and there's going to be a lot of disappointment, and there's going to be a lot of times where you're like, man, nothing's happening. That 1 pound I lost doesn't even make a dent in the 60 I need to lose, but it's not about the 60, it's about the 1, and it's just about like those daily steps. Like, and anyway, so retirement, it's just the same kind of stuff. If you can't save 20% of your income, which most people can't out of school in their first job, save $500. Just get used to the feeling of automating money into your future that you really could use today. Because I promise that, I mean, you probably know this too, man. You got kids and a growing family and a business. Like, there's never a point in your life where you're like, man, I have so much extra money. Like, I totally don't mind if this goes somewhere else.
Oh, yeah.
You never hit a point where you're like, so much excess cash that it just feels great, to have it go somewhere besides spending it on something fun. So even if early in your career you just get used to the feeling of an automated $100 or $500 or $1,000, that's a really good habit to get ingrained in your mind. And it's the sooner that if you're going to be an investor in public markets, meaning the stock market, in your 401k or other accounts, the sooner you can get some experience with that and realize that they are not predictable and they are not guessable, and you can't time these things, and that these things in short periods of time they'll go up and down wildly without much kind of like seeming direction. The sooner you can get used to that pattern and like what that feels like emotionally with $1,000 a month or $500 a month, you'll be way better equipped emotionally to handle it when your account's multiple six figures and it's doing those wild up and down swings. You'll be the person who's like, yeah, whatever, I'm just going to keep saving money, it's okay, while other people are panicking and changing their strategy based on whatever people are saying on TV, So I just think those are really good, healthy habits, like financially and emotionally. It helps a ton.
I want to echo those comments to say, I see people in different places say, talking about how, I knew that stock was going to do that.
Yeah.
And, obviously that was going to happen because this number is lower than that number. And it's like, okay.
Yeah.
The old saying that a broken clock is right twice a day. Thinking you're smarter than literally the smartest people in the world that have been hired to try and figure these things out that still can't do it.
Yeah.
That's a dangerous game to play.
Well, it is, man. It's statistically, look, I mean, in everything's knowable in hindsight. So in 20 years, we'll know all the people that in 2019 were the geniuses,
Mm-hmm.
We'll know that. But I mean, more studies than anyone would care to even go find will show, and I think everyone would probably like recognize this, that the average person trying to time public stock markets is just it's a really rough go, man. And you bring up a good point. I mean, you probably go to some of the same conferences I go to where, I mean, we're talking like double PhD, Nobel Prize winning academics, who spend 80 hours a week trying to like figure this thing out. What are the patterns? What are the charts? What are the, the ebbs and the flows? They still get it wrong all the time,
Mm-hmm.
And it's just a hard game to play. And so again, if a young dentist who's 30 can feel what it feels like to have $500 go in his account or her account and it go down to $400, which would be a big drop percentage wise.
Mm-hmm.
But if you can feel what your 500 feels like to go down to 400, then, and you just keep doing that, you keep, just like going through that motion, you'll be just so much more emotionally equipped to handle it when it's hundreds of thousands of dollars. And you'll just have such a rational, cool head about markets in the future that your friends and your peers will not have if they didn't also start that habit early. So I think it's super important, man.
I agree. And I'm saying this to the listeners out there that are a part of Facebook groups that have, I mean, there's people out there that you can pay them for stock picks. Even it's like you're talking to a bookie at that point of them trying to guess who's going to win the Super Bowl or something like that. And like you said, you have to have the discipline to understand that it's a long-term game, and you have to take the emotion out of it that, okay, yes, if you'd have sold all those stocks at $500,000 and bought this, you'd have $1 million now. But if things went belly up, you might only have 200,000. Whereas with this, you're doing the same thing over and over again. And you went down to 400,000, but that's a lot better than the other way around.
Yeah.
So,
I totally agree. We talk about this all the time. You just reminding me of something I think about all the time, man. And it's like, I'm not going to fault anyone for the path they choose. There's a lot of ways you can make money. There's a lot of ways you can invest. I guess the point is that the path you choose, you have to commit to. Mm-hmm. So here's the wonderful thing, I guess, since we're on the subject, the wonderful thing about the asset that is public stock markets is, historically, and compared to a lot of other asset classes or investments out there, it's a good historical return. The S&P 500 on average over the last 100 years is like 10% a year. That's like the average. That's a good return for what actually goes into it. You can participate in this thing mutual funds nowadays are so cheap, they're almost free. It's basically just like marketing fodder now, that like what the expense ratio is if you buy a cheap one. You can, if you want to, completely outsource to someone for a very reasonable cost. You can put apps on your iPhone to do it for you. It requires almost none of your time. It gives you full transparency, full liquidity, like full information the whole time. So for the very, very little that goes into this thing as an asset, you get a pretty dang good return out of it. And so for me, my personal opinion, what I would advise most people to do is participate it in that way. Like, don't give it a ton of your time and fees and taxes and energy to try to get a little bit better than the average. The average is really good, So but I'm not going to fault anyone. So for the person who's like, I want to spend more time and more money and more taxes for the buying and the selling, and just more of my emotion and energy trying to beat the average in this thing, like, good on you. I wish you good luck. The odds are against you doing that. Statistically, it's just a really hard path, but some people have a passion for it. And the point is either way, you're going to have to stick to it, and you're going to have to take the bad with the good. I would just personally rather say, look, man, this is just an asset that requires almost nothing out of me, while I can just focus my whole life on something else and give me, a pretty great return like 20 years from now. So minimal participation, minimal cost for a good return. I'll take that path. That's just my personal opinion, what I would encourage someone to do with this thing.
You've talked about some of the concepts and some of the disciplines that someone has to have in order to be able to understand retirement as a dentist. Let's talk a little bit more about some of the some of the actual action. So let's say that we have a young dentist fresh out of school. They're going to go work for somebody else, and they see that they need to start saving. How do they go about doing it? Do they need a certain special type of account? Is there some ninja investing strategy that only certain people know about, that you know about, and you want to share?
Only the wealthy.
Now? Exactly.
Yeah.
What does the Illuminati do with their money whenever they're in their middle 30s?
My newsletter that's going to come out. It's a subscription newsletter. I'll give you the secrets that only the wealthy know.
Yes. We need to know. Yes.
Don't do that. Okay, so you're asking, what are like the concrete steps that someone can do to start implementing those habits, right?
Do they need to start like a traditional IRA? Do they need to get a 401k? Because they've heard all of these words before, but most of them aren't really certain of what they need or what they could need.
How they apply, for sure. So the first thing I would say is you spend an incredible amount of time talking to the young dentist now. You spend an incredible amount of time in school and a lot of money to become a dentist, just to even say you're one, So the first thing I would do is protect that. What I mean by that is your career is going to drive everything. The success you have as a dentist will determine how big your net worth can get, how much income you have, and the opportunities ahead of you. So the first thing I'd say is figure out your career path first. And that does include before you're saving money somewhere, and for sure before you're starting to give the student loan as much as you can because it's stressing you out. Don't do those things. First, figure out what your career path is. Are you going to go open a practice somewhere? Are you going to buy in with somebody? Are you going to be an associate for a while or for a long time? Are you trying to get out of clinical as fast as possible and build a DSO? Figure out what that is, because you've already spent a lot of time and sacrifice and money getting to this point. So protect that first. When you're at that point, let's say for a business owner, okay, you just did a startup or you just bought in or bought a practice completely. First thing I would want someone to have is business liquidity. Just protect the business. So, and this is going to vary for everyone depending on the size of your practice and its outgoing, which is what you could help someone figure out is what does it cost to run this thing every month. Protect the business by having the business have enough liquidity, a couple months worth of your business expenses. That'd be like step one. Step two, I would say protect your personal and family expenses. Have a few months at least of just some cash that you could get at it if you needed it. 3 to 6 months in an emergency fund. These aren't big amounts of money. We're not looking for big returns here. You can keep them in cash. You can keep them in other really conservative liquid places. But I would say that's step two. Step three would be once you have your own business and personal liquidity kind of shored up, then you can start thinking about places to save money. And then that it varies a ton, For some people, they might have access to a really great retirement plan at work. And if your employer is going to give you free money, then put money in your plan and get their free money. I would for sure put my savings dollars in there. Eventually, dentists will get to a point where their income and their savings dollars can't fit inside of an IRA or even inside of a 401k. And so they need other places to put it. So most dentists, the people we work with, are going to have their, call it their pre-tax accounts. That's going to be a 401k or an IRA. Those are the, accounts that have limits. They help with your tax deductions, but they have limits on them. And the money that cannot fit inside of those, dentists will open what's called a brokerage account. It's basically a savings account that you can put mutual funds and stocks and bonds inside of and other things. So if you looked at our typical client, you'd see maybe a 401k account and they're maxing that out every year. And then the money that they still have left over that can't fit in there, that's not going back to the business or something else, is going into a brokerage account. And the brokerage account just means you pay tax on the money on the income now, then put it in there. And it's also liquid. So if you need the money in a brokerage account, you can get the money back out. So again, first thing I would start with is like protect your career and this investment you've already made in dental school and the student loans. Protect the business once you're a business owner. Protect the family with some personal short-term family liquidity. From there, here's what I would say. If you're at a point where those things are taken care of and you're now left with, a couple $1,000 a month left over consistently after taxes are paid and your bills are paid, that's kind of the point where hiring a financial advisor starts to pay off. Because truth is, you're worth more money per hour than trying to figure out what type of IRA or 401k or brokerage account to put your money into. And that's kind of the point where outsourcing starts to be more helpful than earlier on.
That makes a lot of sense. So to continue on with that concept, you are going to reach out to a financial advisor. In that you use some terms there I want to define. So when you say outsource, you're basically saying you're not managing your own money at that point. You have someone else that helps you with it. Is there a dollar amount that happens, or is it more of a earning potential, saving, average annual savings, at a point where you typically recommend people start talking to an advisor?
Well, there's two things here. One is an issue of it's a vague term that doesn't have a lot of definition around it and changes depending on the person you're talking to, which is financial planning. Mm-hmm. That's every other question besides what fund do I put in my account, which is like hundreds of them.
I thought that was the guy I called to get my picks for the week.
the hot picks, man.
Yeah.
That's my upcoming newsletter. So there's two things that are outsourceable. One of them is financial planning. Now, unfortunately, financial planning is a very new industry, and we're talking like 30 years old. Mm-hmm. And typically, historically, all it has meant is you buy a product, a 401k, a mutual fund, a life insurance policy, an annuity, a loan, a home loan maybe, and someone says they're your planner now, but all you did was buy a product and, maybe they answered some questions. Financial planning in and itself is every other question besides what do I do with my account? And I mean, it's like it encompasses hundreds of little decisions and things like you can put an iPhone on your app, an app on your iPhone to manage your money for super cheap and really easy. Like there's a lot of companies that do that, right? You can get it on your phone and they'll tell you what to pick. You'll take a quiz. They'll tell you what to pick. They'll put it in some low cost funds. It'll be diversified. That solves one of the hundreds of questions, all the other questions are like, well, who do I call? Let's say who do I call when I want to measure am I on track for retiring or not? Like, is my net worth high for my age? Or who do I call when I have to analyze whether or not I should buy this building or if I should keep leasing it? Who do I call to know, am I saving enough money? Or do I carry the right amount of life insurance or disability insurance? Now, there's people you could call. You could call, if you're making a building decision, you could call the lender. You could call the real estate agent, but you might not get like the most impartial advice on buying the building if you call the agent,
Sure.
And if you want to know how much life insurance to carry, if you call the life insurance salesperson, you might not get the most impartial advice on how much life insurance you should carry. So financial planning is just an impartial third-party person paid, preferably on a fee that's not tied to a product, that will give you his or her time and expertise and tell you what they've seen other dentists do and how to make your decision and be a person that you can bounce ideas off of. There should be people in your life when you make decisions, in all kinds of decisions, that are in a position to tell you no, like that are okay to tell you no or okay to push back a little bit.
Sure.
And a good fee-only independent financial planner can be that person for you. Now, the investments are you were asking about investments, so we'll talk about that. That could be a whole other thing too. Some people love that stuff, man. Some people love researching and they love being a little bit more active with it and they like implementing the stuff themselves. My experience would tell me that the more successful a dentist becomes and the more money they have in their accounts to even manage, the less time they're even going to spend on it. So it's kind of this counterintuitive thing where it's only people with a lot of time on their hands and typically smaller balances that just have the time to even mess with this stuff, So it's kind of like a preference thing on, do you just want to outsource? Again, the stock market is this completely, you can outsource the thing, spend no time on it whatsoever. It's very reasonable cost to outsource to an independent advisor. And you don't have to do anything with it, and get a great return out of it. And then you can spend all the time in the place in your life that no one else can help you with, really, which is being a great dentist. That's all on you, So this dollar amount when it's time to have an advisor take over your account, that's more just like, I don't know. You can do it on an iPhone app. I don't know any really wealthy people that manage, hundreds of thousands of dollars on an iPhone.
I'm sure Bill Gates is doing it.
I'm sure he's doing it.
He's listening right now and we're like, I do it.
Now, look, I'm not bagging on it. I love the technology. It's extremely needed in my industry. Like there needs to be a solution for people with like small accounts that not everyone can hire a financial advisor or wants to. And it feels a huge need. And I think it's really cool, the stuff that's done. It just still lacks. What it lacks is behavioral controls. And money's all emotion and behavior. It's very little like technicalities like we all think it's going to be.
Who are you gonna call if you're managing it through this app and the stock market?
That's what I'm saying. Like
20%. I'm sure you guys had like a ton of calls whenever these last few weeks.
Well, it's been a handful, but that's exactly the point, man. If all of your money's being managed through an iPhone app, they don't care if you panic and sell it. No one's gonna talk you out of that. That's just not gonna happen. So technology solves something, but it can never solve a behavioral component that another human being can help you solve. So I just think this question of like when to outsource different services, of course, it's just going to depend on everyone's situation. But I think a dentist who's in a position of having business liquidity, short-term kind of family emergency fund money, and consistently has, a few $1,000 left over every month, they're going to get quite a bit of value from hiring an independent advisor and planner that's going to be that person who's going to understand all the parts of their life, can give them feedback and context, tell them what other dentists do, give them pushback, say no, and help them make investment decisions on their accounts. Because it's more than just what mutual funds do I put in this thing. Again, the app can do that really well. It's what account types, how much in each account type, how does that change based on my situation, and how do I protect myself from myself for the next 20 years so it actually grows? That's the real issue.
So you mentioned a few things there that I think we should probably clarify what they are. You mentioned being a fee based advisor versus being someone who receives fees based off of selling of a certain product. Would you explain that concept to the listeners, what that means?
Yeah. So in my industry, advisors get paid a few different ways. And I mean, full disclosure, there's not a perfect way to do this. Everyone's going to have a problem with something, and there's always going to be a conflict of interest. I mean, that's just inherently going to exist. And you could tell me every possible way a financial planner should get paid, and I could tell you the pros and the cons of both sides. Because I mean, our whole business is that, and we've thought through that a lot on how do we do this the best, because it's how our business thrives. So an advisor can get paid off of products. That's a really common thing. That's been the old standby in the industry, meaning you buy a product, they get a commission. That financial arrangement is an old model. There's no reason to enter into that relationship anymore because there's so many other options, and it's just bad for you. So paying someone to give you advice and through a product and a commission is just bad. Now that excludes things like, I mean, you got to get a loan. That guy's going to get a commission. You have to buy an insurance policy. Even if it's a cheap term policy, they're still getting a commission. That's okay. People need to get paid for their work, But if you're trying to hire someone for impartial advice in your best interest, you cannot pay them through a product, a commission. It's just not going to work out. So that's one way. The other way is that advisors who are like fee only, meaning they'll charge like an attorney or a CPA will. They'll just charge you for their time. They could do it on an hourly basis. They could do it on a monthly basis. They could do an annual retainer. It's just like, look, my time's worth $10,000 a year, and that's what you're going to pay me on quarterly installments or monthly or one check a year. That's a fee only. That's for like a planning kind of relationship. Investments, you can pay for investments through like a percentage of the money someone manages. So in my industry, it's really typical to pay someone like 1% of the balance that they manage for you. And that usually will go down the bigger the balance gets, right? So an independent advisor is going to get paid on like the fee, like a fee for their time, and by a percentage of the assets they manage. And if someone's getting paid as a percentage, which is, by the way, our company manages money, and we get paid as a percentage of the money we manage, and for our financial planning process, we charge a flat fee based on the complexity and time we got to spend with someone. So, but from my perspective as an advisor, if I'm giving someone advice on what to do with their accounts, I don't care what goes in there. I can use any mutual fund, any stock, any bond. We can hold any position, and it can be as aggressive or conservative as it needs to be for the client. I don't get paid differently for that. I only get paid more if they get wealthier, So it's like, it can align. So where people have to be careful is you want to hire people on that side where it's like fee only. They're getting paid a percentage, or they're just, charging you like a fee for their time, and it's really transparent. The confusion in my industry that's still it's still a bummer to see is what's called dual registered. So people can get paid both ways. So they can hold themselves out to the public as an independent advisor and still earn commission. So, and I see this all the time where someone will say, I'm an independent advisor, and let's say they're charging like a percentage against investment accounts, which appears to be pretty independent and transparent. But they also put a few positions in there of like privately held real estate or oil and gas partnerships, or they sell insurance policies in addition to the stuff that they get paid a commission for that they do not have to disclose directly.
Sure.
So like fees for your time, like if you send someone a bill, like, hey, we spent 2 hours and here's your invoice, that's really like direct and transparent. If I earn a commission for a mutual fund or a whole life policy, I don't have to tell you that. Like legally, that's the crazy thing. Yep. That's not what I do. I'm just saying, if I were in that position, the law doesn't make me tell you what the commission is unless you ask for it. And then I'm just going to hand you like a 50-page PDF and be like, it's in there,
And so there's crazy stories around that. I mean, there is and this will segue us into the next question. There is a financial advisory service company that I know of that they had a lot of their clients invest in a non-traditional asset would be investment. And lo and behold, a lot of the partners in this advisory firm were also board members, or they were very heavily invested in this asset as well. And this investment was doing poorly and they needed cash. They had all these people invest in it. And, 6 months later, it goes belly up and a ton of dentists got left, holding the bag. Yeah. And so this was a fairly well-known and well-respected firm.
Yeah.
And that is something that I actually took to the. So I guess I should also say this was an investment company that did financial planning. It was also a CPA firm. Okay. And I asked my CPA board if that was, if there were any ethical issues with it. And I said, no, there's no ethical issues with that, because there's no way that you could prove that the CPAs didn't think that was what was best for the client at the time.
Yeah. Yeah. It's called suitability. There's two standards in my industry, as you know. There's one called suitability, which in a court of law, if you ever got sued, all you have to do is just prove to the court that the recommendation was suitable, which is a very, it's like I went to a crappy restaurant and I guess it was suitable, but it wasn't in my best interest. The other standard is called a fiduciary standard, and that's the one we heard Congress try to push about 18 months ago that kind of died when the administration changed. And that standard actually holds people personally liable for the recommendations they make. And a fiduciary standard just means that you have to operate in the person's best interest. Do what you would do for yourself or your own parents, Yeah. And they're two very different worlds, man. And the suitability one that you're talking about, the crazy thing is you don't have to even disclose anything. Mm-hmm. You don't even have to tell them until they ask. And it's like, it's just crazy that still exists, but it does. And it's still a chunk of the industry, and it'll probably keep going for quite a while, man. It's really sad to hear that stuff, especially from big reputable places too, because it's not an uncommon practice.
Yeah, I know. And so that leads me into my next question. And I guess I should lead this with both. I am biased because I am a CPA who does not offer financial planning services. And I guess you might be biased too because you're a financial planner that doesn't offer tax services.
Right.
But do you feel like a person should be receiving tax and investment advice from the same person?
Yeah, totally biased. So absolutely not. I'm just kidding. I understand the argument.
Open and shut. Podcast done. Talk to you guys later. Yeah.
Yeah. So, you've probably gone through this in your own building your own business. That's a question we've asked ourselves for 10 years. Like, I know why people do it. It's very convenient to the customer, Mm-hmm. If we also did the bookkeeping and the taxes for every client we worked with, it would actually be kind of cool, because I'd love to see that every one of the dentists in our whole planning system had the exact same set of QuickBooks and categories. That'd be kind of nice, Yeah. And then you have to make the argument, well, like, what about consulting and transitions? And I understand the argument for it, but the problem is also obvious, which is this too, as a business owner, you can only handle so many things. And when maybe margins get thin or things get tough or people just get really, really busy, where is a business going to spend their resources? They're just going to spend it in the highest margin and most profitable area. So if you have 12 services, but you're only really good at 2 of them, and one of them is the only moneymaker, it's making 90% of the revenue, well, what's the experience really going to be for the customer, So we've consciously chosen to build a business that only does financial planning and investment management. That, we don't do taxes or transitions, or we don't broker things, and we don't sell insurance, or we don't do accounting or estate planning and legal work. Just for that fact, we want to be really, really good at the one thing that we do, and then have other smart people that are good at the one thing they do just be involved. And from a planner standpoint, because I still have my own client base too, I like having a third party look at the same situation, but have like no revenue incentive with me. We're not in the same company. So like you like our companies have mutual clients. Mm-hmm. Yeah. So I like when we're talking about a case and you're looking at the same case, but we're not sharing revenue. Like, you could throw me under the bus if I'm being an idiot, Yep. You could call that out because we're not the same company. And I think that's a really healthy dynamic to have. I just think that's healthy. And I think that in a business that does too many things, things will just get dropped, man. They'll just be services that aren't as profitable, and they'll just not be performed as well by the company.
And I again, I feel the same way. I've always seen it from the concept of, if I'm going to do something, I want to be really, really good at it. And I'm really, really good at the tax stuff. I'm really good at the accounting stuff. And I hire people that are good at both of those things. Yeah. And I just don't know how I would manage, this entire other world, because I know that some people like to lump in taxes and financial planning, but they're really they're completely different worlds.
Yeah, man, their entire careers, they're full-time weeks to just do those jobs correctly.
And I feel like some people have some misconceptions that those overlap in some way, that really the only way that I see it overlap is that, there are, some tax savings you can have by creating more tax deferred income. There are some things you can do when you get closer to retirement as far as loss harvesting and things like that. But that's really it. They just overlap in those very two minor areas. The whole financial planning element of someone's life is, that's a full-time job in itself. And so I just don't, I find that a lot of, and another reason I've said it on the podcast before, and I probably shouldn't be so upfront about it, but there are a lot
You're
of
so bold, man. You're so forward.
Yeah. Oh yeah. Everybody from Arkansas is known to be super forward. There's a lot of people in the CPA world that will sell to CPAs, a lot of dentists, a lot of people will sell to dentists, hey, learn how to do implants or whatever it is. A lot of people will sell to CPAs, hey, let's learn how to do investments and how to sell that to your clients so that you can make more money. And it just dumbfounds me, because I'll see these people that are signing up to do this that are, the people I know that are in the CPA industry. It's like, I know you're not going to be, you can offer this service to them, but all you're going to be doing is setting them up with a 401k and then having them go through some type of investment advisory service, and they're going to buy the funds that the investment advisory service recommends.
Yeah. And then there's just some revenue sharing there, and that's one point of contact. Yeah. The CPA in that instance is not becoming the expert. He's not going to add more value to the conversation every time you talk, because it's just a third party. There's very large third party money management firms that go to CPAs and attorneys and just say, look, like, you already have you command the respect in this relationship with your client's finances. So just get their money too, and then outsource it to us. We'll kick you back 10% of all revenue. And then you can just say you do it all in house. And you're just adding services to add more revenue, which I get. Businesses want to add more revenue. We want to grow and make more money, but you're not becoming an expert. You're not adding more value to somebody's life. And that's what happens, man.
The other side of that same coin is that I do feel, some responsibility. I guess I shouldn't say that. Sorry if my malpractice insurance is listening. But I do feel some responsibility to my clients to help make sure they're set up well and make sure they have good advice. And honestly, what I do is I say, the best advice I can give you is to not talk to me about these types of things.
That's good, man.
And, but me saying that sometimes does give me some, I guess professional guilt, if you will. I don't know what else to call it. Of like, maybe I should start learning how to do this stuff so that I could guide people on it. But it's just one of those things that I don't see how the people that do it. But for whatever reason in dentistry, that seems to not be that uncommon that CPA firms do the investment stuff too. I don't know why that is. And, I'm sure there are people out there that are just, dynamic and they can handle all of it. But that's just not the world that I live in, I guess.
Well, look, there are large CPA accounting firms that do in-house investment management, but they're not outsourcing to a third party. They're bringing in partners in very large firms that have, decades of investment management experience, and they're just partnering inside of the CPA firm. You'll see that with legal and accounting too. There's a difference between outsourcing to a third party and calling yourself the contact point for it, and then bringing in another person or another department, which is really what it would take, into your business and saying, yeah, we do this, but we actually have a whole department that does this. Like, that's a very different thing. And man, that professional guilt's real. Like, I feel the same way. You probably feel the same way too when you see a dentist with a struggling practice. You can see collections are stagnant.
Oh yeah.
Profitability's shrinking, and you're like, man, if only like we did consulting too, if only I could just go spend a week with our staff, and we've fought that too. Like maybe we should have consulting in house, but that's a full-time job that people are doing very, very well. And so I'd rather just go find people and say, go hire him or her, they'll do a better job than we could do.
And one thing that's cool is that since we do have such a wide breadth of clientele, is that we do have good referral sources for finding out, if we see what we do a lot of times, if we see somebody do something really, really well or make a big change or big improvement or big gains year over year, I'll ask, hey, what happened? And if they're like, oh, I started using this consulting company, then I'm like, okay, well, I got another referral for whenever somebody says I need a consulting company.
Yep.
And then what's funny is sometimes you then refer that person to somebody else and nothing happens, which is sometimes, I have a feeling that has more to do with the practice that they walk into than it does the consultant and the leadership structure and the team and things like that. But that is something that is kind of cool to be able to help out in that way. It does make you want to be able to do more though. So
it does. Yeah, it's tempting. It's tempting. And I'm sure dentists feel this way too. I mean, general dentists have the opportunity to do a lot of different kind of specialty services, but I know that there's a lot of general dentists who are like, man, I'd love to be able to jump into that case, but that's just not my training. Right. I wish I could help. I probably can because I've seen it so much, but that gal down the street, she can just do it a million times better because that's all she does all day long. Yep.
So I appreciate everyone taking this trip down the guilt lane with Ryan and I. If you're still tuned in, then Ryan, why don't you tell us? It's been a great conversation today.
Yeah, thanks, man. Enjoyed it.
If people want to go hear more, where's a place where they can find you, find your content, find out more about dentist advisors and things like that?
It's great. Our website is full of fresh content all the time. You just go to dentistadvisors.com. There's a tab at the top called Listen, and that's our podcast, The Dentist Money Show. You could also just go to your podcast app, type in Dentist Money Show. We publish an episode every Wednesday. 2 or 3 of the episodes every month are Reese and I, and we just pick a topic of personal finance or investing, and we have a show on it. And then once or twice a month, we actually have a guest on for an interview, and we get their expertise on the show as well. So dentistadvisors.com. And the Dentist Money Show in any podcast app you use.
Awesome. Well, Ryan, we appreciate your time. If you're out there listening, I do urge you to follow the instructions that Ryan's talked about today. These are retirement, something that is going to hopefully happen to you at some point in your professional career. We all hope, both of us on the call hopes a whole lot that does get to happen for you. Yeah. And you got to start soon. So sooner rather than later. You don't want to be one of those that waits too long. Ryan and I both ran into those people, and it's just heart-wrenching to see those type of people, and you wish you could have gotten to them earlier. So guys, go out there, listen to the Dentist Money podcast, and we will see you next time on Start Your Dental Practice podcast. And Ron, again, thanks so much for coming on.
Thanks, John. Thanks, everyone.
So that's it for today's episode, but that doesn't mean that the learning and implementation have to stop there. I've created a free report called The 15 Numbers That Will Make or Break Your Dental Practice. This report has been downloaded over 1,000 times by dental professionals. So if you want your free copy of this report that's going to outline what the most important numbers are in any dental practice, and it also includes how to look at your numbers, how to set goals, has a whole slew of really important information that is the culmination of all of my experience as a dental CPA, then just go to startyourdentalpractice.com/free gift. That is startyourdentalpractice.com/free gift. And so that's it for today, Ambitious Dentist. Again, I'm Jonathan Van Horn, CPA and ABV. I'll see you next week with another world-class practice owner or consultant that will help you start your very own dental practice.